Chapter 2 deals with job order costing, and what we'll learn is that there are two primary cost systems used by manufacturers. If you go to slide 6, what you'll see is that the two types are called process costing and job costing, or job order costing. We will spend our time in Chapter 2 dealing with job costing. Chapter 3, we will get into process costing. So let's look at what we use job costing for. It's primarily used for large, unique, custom order items, such as an airplane, an automobile, construction. It's also used in service industries. Process costing, which we'll cover in Chapter 3, deals with high volume items that are fairly standard and customized. For example, a lot of liquids like gasoline, paint, a dairy farm making milk, a manufacturer that makes nails and screws. That gives you each one. We both have to calculate our product cost, but we'll use slightly different techniques to do that, and we'll look at job costing in Chapter 3 and, in Chapter 2, and process costing in Chapter 3. So if we look at slide 9, we're going to get into the job order cost flow. And you notice on the slide we have the direct materials and the direct labor. And as we learned in Chapter 1, those are costs that we can directly trace to the product, so those follow the good itself. Then we have manufacturing overhead, which are those manufacturing support activities necessary to make the product, but that do not go directly into the product. So those are indirect costs. We collect those in various factory overhead accounts. We allocate those to the product on certain bases that we'll talk about in this chapter. We then finish the product, goes to inventory, and then we sell it out the door. So now if we move ahead to slide 19, we talk about a predetermined overhead rate. And the reason that this is necessary kind of flows from the last slide. And what we do with this predetermined overhead rate, we have to figure out a way. How are we going to take all these factory overhead dollars that we've collected? How are we going to take them and allocate them to the product? Well, the way we do that is we have the numerator, which is made up of all the manufacturing overhead costs, and we divide that by some type of activity, typically direct labor hours or direct labor costs, and then we get either a percentage, as in the example on the slide, or we could get our overhead rate X amount per direct labor hour, and that's how we would allocate it to the finished product. So if we go to the next slide, we're going to look at how these cash flows work. So on slide 20, we see the cash flow. It flows from the material tickets all the way through to the job cost sheets, where we have all the costs collected for each of the products. In slide 22, you'll notice we have our T accounts, where we have the material purchases going into inventory as a debit. As we pull those out and we send them into work in process or goods in process, we carry those over there, and you'll notice that the indirect materials, such as the lubricating oil for the machinery, that goes into our factory overhead account. So if you move to the next slide, then we have our labor costs. The same thing, direct labor goes into the goods in process. The indirect labor gets collected in the factory overhead. At the end of the period, we apply our overhead based on this predetermined overhead rate that we just referred to, and we put that into goods in process. And then moving then to slide 26, why do we need a predetermined overhead rate? Well, because some months our activity isn't as high as in other months. Some months we incur overhead at different rates. For example, in the summer, when it's typically hotter, you have air conditioning costs, so your utility costs will go up. And so by doing a predetermined rate for the full year, we're able to smooth out and even our production cost or our product costs, so we don't have to raise and lower our prices throughout the year, which would then bring a whole host of other problems associated with that. Now, finally, if we move to slide 30, you could kind of see coming up here is that if we take our actual overhead and it's greater than what we applied using our overhead rate, our overhead is considered to be underapplied. Our cost of goods sold is too low, and therefore we have to make an adjustment to cost of sales to make our cost equal to our actual costs. Consequently, if our actual overhead is less than, or we've applied too much overhead compared to the actual, we've overapplied, and our cost of goods sold in our financial statements would be too high, so therefore we need to make an adjustment to decrease the cost of goods sold. So if we look at that in summary then, the whole purpose of this chapter was to introduce us to job costing, which again is for single, unique, big ticket items, and it's a way of allocating costs because our goal at the end of the day is to come up with an accurate product cost so we can use this for purposes of pricing the product. When we move into chapter 3, we will then be talking about the other major costing system, the process costing, which is used typically for higher volume, more standardized, less unique products.